Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is April 15th. Let's dive into the week's stock market news. European markets stumble as investors assess central bank policy. European stock markets experienced a decline in local currency terms on news of accelerating US inflation. The Pan-European Stocks Europe 600 index ended 0.26% lower, with major country indexes also falling. Germany's DAX lost 1.35%. France's CAC 40 index declined 0.63%. And Italy's FTSE MIB slid 0.73%. However, the UK's FTSE 100 index bucked the downtrend, gaining 1.07% with support from the British pound's weakness relative to the US dollar. The FTSE 100 includes many multinationals that benefit from overseas revenue. The initial downward trend in European markets was driven by a jump in yields on French, German, and Italian government bonds following the announcement that US inflation had accelerated faster than expected in March. Yields subsequently pulled back from their highs as the European Central Bank, ECB, held key rates steady, but strongly hinted at potential rate cuts in the near future. In contrast, UK bond yields rose, partly influenced by hawkish comments from Bank of England policymaker Megan Green, who warned against premature rate cuts. ECB signals potential June rate cut. As expected, the ECB maintained its deposit rate at a record high of 4.0%. However, the ECB indicated that an updated inflation assessment due in June could lead to lowering the current level of monetary policy restriction if it confirms a sustained path of inflation convergence towards the target. When asked if strong US inflation data would influence the policy path, the ECB emphasized data independence and highlighted differences between US and Eurozone inflation. UK economy shows signs of recovery. In a positive development, UK gross domestic product, GDP, expanded 0.1% sequentially in February on the back of rebounding manufacturing output. Additionally, January GDP growth was revised upwards to 0.3%, indicating an exit from recession. During the 3 months through February, gross domestic product expanded 0.2%. Eurozone confidence improves. German output rises. Investor confidence in the Eurozone increased in April to its highest level in more than 2 years, according to an index compiled by Centix. The Economic Expectations Barometer turned modestly positive for the first time since the start of the Russia-Ukraine conflict. Industrial production in Germany experienced a strong second consecutive month in February, rising 2.1% sequentially on the back of increased construction output. However, in the 3 months through February, production was 0.5% lower than in the previous period. Now our insight into alternative markets. US institutional investors sell private equity holdings at discounts. US institutional investors, led by pension funds and endowments, are increasingly offloading private equity holdings at slashed prices on the secondary market. This sell-off reflects a broader trend of institutional investors seeking to reduce their exposure to illiquid assets, as highlighted in a recent Financial Times report. The data paints a compelling picture. In the past 3 years, A staggering proportion of private equity holdings sold on the secondary market have been at or below their net asset value, a 99% in 2023, 95% in 2022, and 73% in 2021. This trend, tracked by Jefferies since 2017, indicates a significant shift in the market. This surge in secondary market activity is driven by a slowdown in traditional private equity exit routes such as initial public offerings, IPOs, and mergers and acquisitions, M&As. As a result, investors are increasingly relying on the secondary market to liquidate their investments. For pension plans with obligations to disburse funds, the secondary market offers a quicker way to access cash. Public pension funds have for many years poured money into private equity on the premise that it was high return and low risk, while illiquidity was deemed not to be an issue, said Richard Ennis, co-founder of AnySnap, a consultancy specializing in pension plans. They are now discovering that pay is no magic bullet, and liquidity does matter for investors with a sizable payout requirement. Public pension funds in North America continue to increase their allocations to private equity, with an average of 11% of assets allocated to the asset class last year, up from 8% just 3 years ago, according to Prekin. However, as investors seek to manage their exposure, secondary sales have become an essential liquidity tool. The global private equity secondary market saw substantial activity last year, with $112 billion in transactions, according to Jefferies. One notable example from Q4 2023 is the $137 billion New York State Teachers Retirement System, which sold 34 private equity holdings with $3.5 billion in total commitments on the secondary market.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.